When you mention India, I take note. Just in time for, oh, Diwali? Last week, the biggest precious metals refinery in India ran out of metal. You can't miss Diwali. Here we are at the Festival of Lights. If I messed up, please accept my apologies. I think it's Diwali, or maybe it's Diwali. Additionally, you are witnessing tremendous strain in London while this is happening. There have been rumblings about a real silver shortage in China and a stalemate in the supply chain, according to reports. Not only are central banks purchasing gold and silver, but they are also doing so for the first time in over half a century. In August, we witnessed the Saudi central bank buy about 30 million worth of SLV. The amount they purchased would enable them to take ownership, SLV, and I'm practically choked just typing it. Then there are rumors that overseas investors have more gold on hand than the United States government does. The percentage of U.S. treasuries held by foreign investors has reportedly decreased from 49% in 2013 or 2012 to 31% currently. All this is happening at the same moment, though, and the banking sector is showing signs of serious stress. Two major car parts suppliers have already been introduced to us, Auto Supply and Tricolor Subprime Car Lender. This private equity firm's dealings with subprime car lenders led to its recent collapse. It is also associated with regional banks. Plus, Jamie Dimon steps forward to compare it to a cockroach. Just when you think you've found one, more pop up. Kristalina Georgieva, I believe her name is the head of the International Monetary Fund. This, she claims, hinders her from sleeping. After that, the repo market comes into play, where banks suddenly start to pledge toxic assets like mortgage-backed securities instead of treasuries. This is because the commercial real estate market is causing the banks to stress out. Observing the current state of the repo market reveals that the banks are once again facing difficulties. In addition to the issues we've already discussed, there is now the simultaneous occurrence of a government shutdown, strain on regional banks, and the beginning of the collapse of private equity, which further strains the banks. Furthermore, I believe that the 9 consecutive weeks of gold's upward trend may have begun to unsettle some individuals, particularly the major banks that have these substantial amounts. And the assault is well coordinated. I don't know who did that. Just why did they do it? Who or what is driving this? We might never find out about all of that. If there's one thing I can tell you, it's that the mainstream media's claims about gold and silver's outperformance since our initial interview 3 or 4 years ago are completely false. On top of that, they repeated themselves word for word throughout. The problem is that they keep changing their estimates. Further evidence that a 25% allocation to gold is reasonable comes from bond sales magnate Jeffrey Gundlach, who just came out and said as much. When it comes to bonds, this man is unrivaled. If Michael Hartnett, the chief investment officer of Morgan Stanley, says 25% gold, or if Jeff, the head trader at Jefferies, says 6,600, then you know the market is headed in the right direction. Those at extremely high levels are discussing this, Massive shipments are arriving at COMEX, and all of this is happening simultaneously. Some are afraid because there are those who are overly indebted and can't get their hands on metal. Additionally, the settlement in London is a T+1. Delivery can take 4 to 8 weeks, according to what we've been told all year. The paper market is at odds with the actual market, which adds further tension to the situation. Could you tell me who's responsible? Why are they doing it? It's something I'm not familiar with. All I can do is hypothesize and make educated guesses. The mainstream narrative, though, is making me sick to my stomach. Because sure, it's mostly accurate. However, once you've shown that it was accurate, you'll need to address the resolution. This is not the way they would be handled either. There is a better approach to resolve it than the way it actually occurred. Therefore, it is not merely ordinary market behavior, in my opinion. Anything will do. However, the act of a drive-by shooting is a desperate attempt to create the illusion of reality in order to mislead others. This is the pinnacle of deceit. Plus, it's exactly what we've witnessed previously. A $250 decline in gold makes you sick to your stomach, but it won't frighten someone who has been trading for as long as me. The fact that we haven't seen these paper charades or drubbings in a while tells me that the physical demand is going to eventually be too much for them. Yet here it is once more. Because it occurs only every 240,000 days in an average market, it is clear that this one is extremely desperate. According to Michael Lynch, 1,169 contracts were sold by Barclays, 1,076 by RBC customers, and 2,024 by Scotia House accounts. May it be the result of cashing out from previous purchases? Very possibly. However, when you consider that 2,000, 3,000, 5,000, or 6,000 contracts are involved, that's a substantial amount of gold being dumped at 100 ounces each. Who would do that and why is a mystery to us? However, he claims that the banks in question are not American. His examples are Barclays, RBC, and Scotia. Plus, he possesses a plethora of empirical evidence. Can he vouch for it? Feel free to check out his Substack if you're interested. Based on his investigation, he has published what he considers to be the data and fingerprints that reveal who sold. Their situation is hardly unique in my opinion. However, it is analogous to attempting to move a boulder downhill. Snowballs, like rolling stones, keep getting bigger and bigger once they get going. Due of its ability to induce stops along the road, it is growing in size. Many individuals who bought into this rally likely assumed they wouldn't have to trigger their stops after purchasing into this crushing loss. This is, however, my best guess as to what transpired during the wee hours of the morning, when the price fell precipitously due to a lack of liquidity. Additionally, the precipitous decline would be exacerbated by the myriad of triggers that would be set in motion to sell in order to safeguard these monies. The entry of the value purchasers immediately sent it soaring again. Both the coordination and the stupidity of that are too great to be coincidental. No, so it's a mixed bag. I mean, expecting it to go straight up seems unrealistic to me. In my opinion, though, looking at the big picture, I see it continuing to rise. I do believe that the bull wants to bring along the fewest number of passengers possible, Michelle. Therefore, I believe that market forces will prevail in the end. However, many prominent figures are fundamentally wrong and on the opposing side of this. The other day, Bob Coleman brought up the fact that the managed funds are basically short 1 billion ounces of silver. Massive indeed. It is vast. Therefore, it follows that there are other parties involved who stand to gain from it. With that type of volume, though, on a system that rehypothecates and trades contracts, take our upcoming guest, David Jensen, as an example. In London, he mentions a 140 million ounce float that is capable of trading 600 million ounces of deliverable contracts per day. There are contracts out there with a potential value of 2 billion ounces that could be fulfilled with just 140 million ounces of float. I don't see how this could go wrong now. Is there anything that could go wrong? Maybe that's why Eric Young claims the LBMA offered China these outrageous prices. This is urgent. It is necessary for us. For that reason, we will be subject to the exorbitant lease costs. The collapse of silver is just one component when you play a game and observe. Every one of these banks is involved in more than just bullion, for instance. If one of them had a big delivery failure involving silver in London, for instance, they have a hand in every asset that could be exchanged on a global scale. The ripple effect on the entire system would be devastating. It would destabilize some of the world's most powerful financial institutions. This is taking a step in the direction that Tom Wongo describes as an assault on the European nobility and the Bank of England. Plus, I have no proof that that is accurate. Tom is convinced. In my opinion, it is clear that there was coordination because of the manner things were done and the subsequent intervention that brought silver back into the positive territory. Players may have conspired to lower the paper price so they could buy physical at cheaper rates and fulfill short contracts that were almost ready to trigger the long-awaited massive squeeze. Might that be the case? Well, I see no reason not to. Profiteering has its justifications, but it has risen too far, too quickly. You should take a profit, according to the technical analysis. Yeah, part of that is right, and I think that's accurate. But I think that's only the surface level of a much larger story. In all candor, I believe that to be the most important thing I have learned from this. In my opinion, there is no other way to avoid it. Free markets no longer exist. Instead, they are manipulated, Michelle. Yet, these commodities and investments are clearly migrating to the east and south of the world. The BRICS facility they're constructing, as well as the emerging exchanges in cities like Moscow, St. Petersburg, Dubai, Singapore, and Shanghai, will replace the LBMA and COMEX as the primary mechanisms for establishing prices. Even if it's not the COMEX, President Trump should have something planned. On the other hand, I think we are seeing the end of the Western commodity pricing system. When you examine these global transactions, you'll see that they mostly involve cash and carry, payment, and receipt, especially those that are rehypothecated in this way. And let me take you back to 2020 when oil prices dropped to $40 per barrel amidst the epidemic. What the fuck happens when that happens? When does a barrel of oil drop to $40? Taking the oil will earn you money. You have an issue, I suppose, when the futures market sets the price of the underlying commodity and is thus acting as the dog's tail. The futures price should be determined by the commodity, not the reverse. Furthermore, I believe that the global community is becoming increasingly frustrated with the West's ability to maintain control over the commodities complex over the years. That is why I have consistently brought up the fact that the BRICS nations are up against it, and if you look closely enough, you will see who is purchasing all the gold and silver. The countries in question are Russia, China, India, and Saudi Arabia. Remember how the International Monetary Fund, IMF, blacklisted Saudi Arabia and China for failing to disclose their foreign exchange reserves? So we know this is true. We have no idea how much they are purchasing. Additionally, the $9.99 threshold that the IMF requires for reporting would not be met by China's acquisition of doré and concentrate. These nations are making every effort to play along with the West, including lowering the price of paper and waiting for cheaper goods to be delivered. It's just that they're on the opposite side of us in this game. They're driven and well-coordinated. Because of a huge long position, 2 billion ounces, according to David Jensen, of deliverable contracts against 140 million ounces of accessible supply, the London float has been dragged down, causing the low float that I've been complaining about for years. Who knows if that's accurate? Otherwise, you might try to guess his name, which sounds like Bruce Ikamoto or something. His responsibilities include leading TOCOM in Japan and trading deliverable platinum contracts in London at a rate of 3 million ounces per day. According to him, neither London nor Switzerland have any physical platinum on hand. Despite this, they are exchanging contracts for the delivery of 3 million ounces every day. The makers, collectors, and those who comprehend its significance will eventually be irritated by that. Once price discovery is rendered irrelevant by such pranks, the West will inevitably face competition over the power to set commodity prices. Because these nations lacked coordination, motivation, and an eye towards seriously opposing the West, I believe this is being utilized against us. They already do, and they can pull it off by standing for delivery and taking advantage of our foolishness by controlling paper prices in the wee hours of the morning with paper contracts instead of the actual thing. Who knows? I can tell you this much, though. According to what you'll hear on Bloomberg, CNBC, or Reuters, very little of it has anything to do with the real motivations or identities of the people involved. I hold that belief.